Hello, everyone. Great. Let's get started. Okay. Hello, everyone. Welcome to our webinar on buying a business with the Small Business Administration, commonly known as SBA Lending Program. Today, we're going to cover some helpful information as well as tips on how to use SBA in the acquisition of an online business. This session is tailored to those with an awareness of what SBA is and understand the basics of the program. So if you're new to SBA and would like to speak to someone to learn more about the program, our contact information will be shared on the last slide. Let's get started. My name is Kevin O, and I lead the SaaS M&A department here at FE International. I have with me today Jordan Richmond, who is Vice President of SBA at Fidelity, FE International's preferred SBA lending partner. A quick overview of FE International for any new buyers to our network. FE was founded almost a decade ago to provide M&A advisory services for mid-market SaaS, e-commerce, and content businesses, ranging from 100K to 50 million in enterprise value. To date, we have completed over 750 transactions, totaling over $500 million in acquisition value, and we have 4 offices across North America, Europe, and Asia. Our buyer network is mostly made of PE firms, funds, strategic buyers, and high net worth or experienced individuals, and we only bring about 1.9% of leads that inquire to list with us out to market. So our network is fairly exclusive and high quality. In fact, we have helped many buyers successfully use SBA to acquire businesses over the past few years, and several of them with Jordan, actually. We also have several SBA opportunities currently available, so please feel free to reach out to me directly if you would like to learn more there. With that said, I'll hand it off to Jordan to tell you a little bit more about himself, Fidelity, and about the SBA program. Go ahead, Jordan.
All right. Thanks, Kevin. Thanks for setting this up. A passion of mine is to educate and teach, and I love, what I do. And so opportunities to actually get, any kind of educational and informational broadcasting out there is passion of mine. So I'm happy to do this. And like Kevin said, there'll be a slide at the end that has our contact info, but anyone feel free to reach out with questions. I believe there's a way to type into the box at the bottom of the webinar, and I can field some questions at the end for all of you guys. Like Kevin said, I'm an SBA lender at Fidelity Bank. Fidelity is a full service bank based out of Atlanta, Georgia. The slide you're looking at, just to be aware, will be changing. Last December, we announced a merger with Ameris Bank, who is also a national SBA lender. So some of these statistics will change, but at the heart of it, I am a national SBA 7A lender for Ameris and Fidelity Bank. We have been doing SBA Fidelity for about 10 years in the 7A space and in the national lending frame. We do, each of our 2 SBA departments do about 100 to 150 million a year in SBA lending. So we're, between the 2 of us, will be somewhere between 200 and 300 million in 2020. About myself, I'm based out of Boston, although I do lend nationally. My specialty is advising buyers in M&A transactions. I think we excel from about the $500,000 transaction range to about the 2.5 million to 3 million transaction range. Seems like we're giving borrowers a lot of solutions that aren't really available in the marketplace, and that seems to be where my sweet spot is. And like I said, we are a full service bank. We are based out of Atlanta. We have branches in Florida and Georgia, but we do lend nationally for M&A transactions, such as the one that Kevin deals with. And I'll let you know a little bit more about the SBA 7A product, how we use it to complete e-commerce, SaaS transactions, and any online business transactions, and kind of fold that into some common transaction structures we see with FE at the end. That said, let's hop right into it. Let's go to the next slide, please. And just a little bit about the SBA lending in general. A very high level overview is there are many different industries and different types of loans you would use for the SBA. Like I said, I specialize in large goodwill transactions, essentially people who are buying businesses or people who are merging with other businesses. So specifically what I do is business acquisitions, large goodwill. I would say about half of my business is e-commerce or SaaS. And then I have another silo that deals a lot with franchise resales and just other manufacturing businesses. Along those lines, the requests that I get are typically for the purchase of goodwill or intangible assets. But a common question I get asked, and the reason I put this on here, is we do fund working capital. If there's a large receivables need, we'll certainly assist with that in the purchase of a business, and we'll also pay for inventory as well. So besides just the intangibles, we will also give you some money to actually operate the business. Typically, what we've been seeing in the marketplace is transactions. Like I said, I typically specialize with e-commerce and SaaS in that 500,000 to 2.5 to 3 million range. However, as a bank, we lowered our minimum loan amount, or raised it and then lowered it to about 250,000. And typically, what I will see is 90% financing of goodwill transactions up to around 1.5 million in complete unsecured goodwill. However, the deal size I've done as large as 3.5 million, I think is the largest deal I have in my pipeline currently. Another bullet point that I added purposefully is because a common question I'm asked is, do I need to own a business, or do I need to actually been operating a business to get an SBA loan or purchase another business? And the answer is no. However, a very strong component of lending to goodwill is business acumen and experience. So although the ownership is not required, transferable skills are certainly necessary. In a few slides, you'll see some of the transactions I've completed in the past, and some there is business ownership experience, but in all, there is some kind of transferable skill set where we can draw lines and show, that there's either significant business development on maybe the SaaS side, or significant marketing on the e-com side, coupled with management and just technology skill sets as well. And that said, that is probably the largest component to getting approved for this is the personal acumen. And then just all loans tend to be 10 years, fully amortized, no balloons. And then just to tack on to the very end, we also do 504 and B&I transactions. However, I would say I've done probably 20 transactions this year, and there's only been one 504. So really, that goodwill or intangible asset financing is probably what I will specialize and invest in. And we'll kind of go over some of those transactions on the next slide. Could you advance the slide for me, please?
And Jordan, I just want to interject here. So
this is just to kind of give you an idea of what we do
that,
well, and kind of where we
has to
fit
be based
a need
in the US for it to be SBA eligible. You and I know that
these are
I've sent over a few businesses your way that were based in the UK, and they were deemed to be SBA eligible. So
questions that I'm consistently asked.
If there's a business that you're looking for and it's based outside of the US,
what are the
as
loan
long as
sizes,
you as an
what's
individual
the
or as a business are based in the
historical cash
US,
flow or lack
chances
thereof.
are that it could be eligible.
And this first one is a very good example and a very common question I'm asked, which is, can we purchase a business that is outside of America? And the answer is yes. If the assets, meaning goodwill, is coming into the States and being transferred into a US corporation, then the answer is yes. Just this year, or I think it was actually last year, we funded the acquisition of a Canadian SaaS company. It was 100% goodwill, and those assets were initially in Canada. It was a Canadian company where another New Jersey company came in and bought it. It was, I think, a $1.7 million loan amount, and it was all, like I said, SaaS and goodwill and intangible assets coming into the States. So again, international is okay. The caveat there is that it's tax returns we can read, so United Kingdom, Canada, other countries that have their tax returns in English and also can verify those returns with some kind of revenue department, the tax department of the other country. We were able to get around that and be able to fund those deals. Please. Correct. Yep. As long as the buyer is a U.S. entity, the seller does not have to be. Is the the high level takeaway from that. And good point. I appreciate that, Kevin. Another thing we're seeing a lot of recently is also partner buyouts. We've been going over our goodwill requirements, and going a little higher for the unsecured amount just to get these partner buyouts. In that regard, we look for business acumen, we look for business ownership, is always a plus. And in a scenario where we have a partner buyout, significantly stronger deal. You have a partner who not only has the industry experience and the skill set to run the business, but they've already been running the business. So we have been seeing a lot of that. The next one, that $850,000 acquisition of a SaaS company, Kevin actually duplicated that below as well. And just to give you a high level of that, there was no historical debt service calculation. There was no historical cash flow. A buyer came in and had bought a business 6 months previous. We did the second transaction for the borrower to kind of fit into his portfolio of online businesses. And that was the second transaction in 2 years. So that's another common question that I'm asked is can I buy a business and then buy another business and rinse and repeat and build a portfolio of possibly Shopify, possibly SaaS businesses that have some kind of synergistic purpose? And the answer is yes. We've done a few of those this year, and I think we do them very well. Then the rest, I do go outside of online businesses and tech companies and engineering, medical. We have various business silos as well that have a whole host of other guidelines, but we can go into that at a later time. And then the last bullet point, again, the $400,000 e-commerce business for hunting tools that we've closed with FE. That was another one where it was a serial entrepreneur. He had 3 businesses over the course, or 3 acquisitions over the course of 3 years. That was completely intangible. There was no collateral to secure to. The SBA had secured to his real estate in previous transactions. So again, that's something we're comfortable and we're used to being able to fund, just for lack of a better term, a complete airball where we're just buying the cash flow of the business, and as long as we can show that cash flow and show that is consistent and historical, we're okay lending without any collateral. And if you want to go to the next slide, we can kind of talk a little bit more about the parameters, a few more parameters about the SBA 7A program in general. Again, to Kevin's point in my previous one, they do need to operate for profit in the United States. They can export. They can operate within territories, Puerto Rico, that kind of thing. And they can take intangible assets from other countries like the United Kingdom or Canada as well. There are size requirements. Many times I see PEG groups coming to me or people who are doing roll-ups. And an important benchmark is we are not to exceed 15 million in tangible net worth or 5 million in net income. Note that's not gross income, that's net income. So many times we'll see, someone with a portfolio of businesses that get up to 10 million or 15 million in revenue. However, net income is the fulcrum there to decide if it is SBA eligible, and the SBA's definition of small business needs to be met, and those are the 2 items to bear in mind. As far as the terms go and just general broad strokes on what a business acquisition loan will look like is the max exposure for any bank on an SBA loan or a 7A loan will be 5 million. They're all fully amortized with no balloons or call dates. Typically, the next bullet point you'll see there, they say the terms are 5 to 10 years, and then real estate obviously will have a longer maturity. However, I will tell you, out of all that, I don't think I've ever done a term shorter than 10 years. So for cash flow and forecasting purposes, a buyer wants to assume a 10-year loan fully amortized at prime plus 2.5. The rate is, give or take, but that's essentially where it's at. The rates are based over the prime lending rate, which is currently 5.5%. and the rates will vary, but typically you'll see, I would say 90% of the loans again are prime plus 2.5, and prime right now is 5.5%. Something else to be aware of when you're doing SBA lending is the SBA is not a bank. We are the bank. We are the ones giving out the money. We do, however, we are a preferred lender in that we approve loans on behalf of the SBA, which is a rather coveted status to get for lenders, and especially on a national basis. The reason we do use the 7A loan in purchasing goodwill is many banks conventionally, they will look at a business purchase as a startup, since business ownership is changing hands. Although there is historical cash flow, they would be considered a startup. And also, on the deals that I see more often than not, there's a significant lack of collateral sometimes. And the SBA will guarantee, in the case of default, up to 75% of the loan amount. So on $1 million, on $1 million loan, in case of default, the bank would go to the SBA for a recourse of $750,000. So it's a significant credit enhancement, and it's how it allows us to make loans that wouldn't otherwise be made without a 7A loan. And for that, the cost for the SBA, it's not a bank fee, it's an SBA fee. It can be up to 3.75% of the loan amount. And that is based off of the guaranteed principal. And just, I can go over this on a more granular basis offline, but it is a tiered SBA fee you pay. Typically, what you will be paying is 3% up to, I think, $1 million of the guaranteed amount, which is 75%. So it's really on, a $500,000 loan, you're paying, the net fee is 2.25%, if you think about it that way. So I know people look at, almost 4% in fees. Again, that's a tiered scale going up to 5 million, and it's net of what the guarantee is. So in reality, on those transactions from about $500,000 to $1 million, the net fee amount is roughly 2.25%. And again, we can use it for expansions and renovations, new constructions, working capital, and again, business acquisition, which is almost 100% of the loans I do. Those business acquisitions, again, will come with working capital, especially if there's a need for receivables and inventory. And that said, there are certain eccentricities to doing goodwill transactions, especially online business transactions. In the next slide, we'll kind of go over some of the deal structuring that is common to these
Jordan,
deals.
Just to chime in here, I think what I see from my end is a lot of the times when a deal is getting negotiated,
I do like to land
the
on this
note tends
slide
to be an
because
element where the seller and buyer ultimately try to reach an agreement in light of total consideration.
You can get
the important thing I want to stress here is that the bank also has discretion in terms of how the note is structured and paid out.
Loan structures for goodwill transactions,
something to keep in
all
mind
of these bullet points I'm going to go over are relatively uniform.
Specifically, that ultimately may end up being changed in order.
The first thing I wanted to discuss, and I've kind of alluded to it many times, is we will.
And there's one thing I want to say there just before we transition to the question.
Cash flow lenders, we will fund just a goodwill transaction. And when we look at that, you want to look at what the goodwill max will be. All banks have a goodwill, tolerance. And typically you see some banks, depending on the industry and the transaction, will cap it as low as 350,000. Many will go up to about $1 million. We do go up to 1.5 million, which I think is rather aggressive in the marketplace. And a common question I'm asked by FE buyers and just, tech buyers in general is, what is the goodwill and how is it calculated? So to keep this in mind, the goodwill will be considered after you factor in buyer injection, collateral, and seller financing. So I'll give you a good example. I just wrote up a term sheet yesterday for a $2.3 million transaction, I think $2.2 million transaction. That is coming with seller paper for $350,000. It is coming with buyer injection of, I believe, $350,000, and also mezzanine financing of $350,000. So, in that regard, I'm sorry, the purchase price went up to be 2.5 million. So in that regard, you would look at it and you would say, okay, we have between buyer and seller injection, we have 700,000 in equity going into the deal. So that reduces a $2.2 million transaction into a $1.5 million transaction. And then the inventory need was about 350,000 as well. So now we're clearly over what that goodwill threshold is, closer to 1.9 million. We were able to bridge that with mezzanine financing, which is debt. It's not equity. You're not giving away equity of the company to fund that. But just, that's a way to get away of, if you have a very large goodwill transaction, mezzanine financing, seller financing is available. And then any collateral we factor in, you can remove that from our max airball, so to speak. That said, another very common conversation when looking at SBA loans and requirements is the SBA collateral requirements. Excuse me. The collateral requirements are, although the SBA and our bank will not decline a loan based solely on lack of collateral, we do have to take any and all available collateral that's listed on a personal financial statement and any personal assets as well. That can include personal real estate and also commercial real estate. The threshold for that is we will look at the value of a home. We will margin it at 85%. And if there is additional collateral past that, after you subtract the liens out, we will take that. So that's not a bank requirement. That's an SBA thing that you will not get around and uniform within the industry. To give a quick example of that, on a $1 million home, we would margin that to $850,000 or 85%. If there was a $500,000 first mortgage on it, you would now have $350,000 in available collateral. So had that scenario been available in the previous term sheet I wrote up yesterday, we would be within our airball threshold and okay to proceed. Next bullet point, equity requirements. Up until the beginning of 2018, it was highly typical to see a combination of buyer and seller paper, or a buyer injection and seller paper up to 25% of the transaction. Now more typical, since 2018, the SBA changed their SOP and they deleted the 25% requirement for goodwill transactions. And we are now seeing many of the transactions will either have 10 or 15% equity injection for the buyer. So it's been highly competitive since then. I think that a lot of buyers are now using the SBA to leverage the 7(a) program and buy businesses that they hadn't previously. And that is the one finesse point is discussing what the injection will be. And although the minimum is 10%, many banks and many debt service requirements, you'll have to get into that 15% realm to make the transaction more palatable for the bank. Another common question and another common requirement from the SBA is we need to show some level of historical cash flow, whether that be from the business you are buying or from the existing business. In general, from what I see in the online business world, I believe the ability to service debt is typically stronger in online businesses than other businesses, manufacturing or just Main Street retail. We will go down to in theory, we will go down to the SBA minimum, which is a 1.15 debt service requirement. However, with online businesses, I typically see, especially FEs, more of the ability to service debt around 1.5 times. And just to put that in a ratio that, with real numbers to digest, if the annual debt service is, or if the annual debt payment is $100,000, annual loan payments are 100,000. We want to see free cash flow of 150,000, and that would be a 1.5 debt service requirement. I know that's getting a little bit more into the weeds, but something to be able to get your arms around and look at. If you have a higher multiple company, I know a lot, larger companies will certainly have a higher multiple. you can offset that lack of debt service with an existing company or external income as well. Lastly, the other thing I will say lastly on the debt service is that we also look at a global consideration. So if you are buying a business that has a much lower debt service, and this is a synergistic acquisition, say you're taking another component of an e-commerce business and now you're expanding from specialty apparel into another type of specialty apparel, we take that into consideration from a global standpoint, and we will have lower debt service requirements as well. Common question is if seller notes are okay, and the answer is yes. Typically, when you do factor in a seller note, we want to see that it does not hamper the cash flow of the business and shows that the target business still has the ability to service the debt, and we don't want to stress that cash flow. So it's very typical where we will ask for a seller note to be on standby for 2, and I personally think 3 years is a much better position for the buyer. Many sellers are not okay with that, and it's not palatable for the seller, so that's completely understandable as well. So that depends on the transaction, but certainly available if need be. And we like it because it'll lower the total loan exposure to the bank and therefore lower the debt service. Yeah, that's a very good point, and I think how FE when I get businesses appraised or have in the past with FE, I mean they certainly appraise for what the sales price is, and that seller note almost becomes a negotiation point. And I mean, if the seller is holding back paper, there is consideration for that too. So not only is it the bank may mandate how the loan should be structured or how the seller note should be structured, but it could actually cost the buyer something at the end of the day, because now the seller has a holdback, and the time value of money or the opportunity cost of the buyer not getting paid 100% of the transaction is a rather large factor as well. Thank you for pointing that out too. And then again, something I'm seeing a lot with FE buyers and a common conversation is, people creating a portfolio, people using, their existing engineering, their existing staff, their existing accounting, and creating synergistic acquisitions. And to be frank, we like them. They are case by case, and the largest caveat is setting up a direct timeline. We do want to see that the first business has been stabilized before we move on to the next one. So this is the short answer to a very common question is, can we do it? And the answer is yes. And the way I typically put the answer to many of these questions are engage the lender or myself sooner rather than later. We want to know what we're dealing with. We want to look at each individual credit stand alone and say, if there's significant cases, we may speed up that time horizon to the next fiscal year, or we may want to see an actual 12 months of history. I'm doing a file right now where we have significantly less than a fiscal year, but we're getting compiled financials. And that's, if we have CPA financials, we show that there is that amount of historical cash flow that can be not verified by the IRS, but the CPA is something we can get more comfortable with. Again, source funding and mezzanine debt deal structures are also on the table. Source funding is directly correlated to the who must guarantee bullet point as well. So, in many cases, I'll see someone coming in, they might only have 50% equity of the company, and they have 5 buyers who all have 10% of the company, or five investors. That is fine. Just bear in mind is as you're structuring your transaction, anyone who has 20% or more and 20% literally is the threshold. So if someone does not want to guarantee or does not want their personal financials to help be a credit enhancement nor guarantee, they must be under 20%, meaning 19 and a half. But as soon as someone hits that 20% threshold, they will be asked to sign and guarantee. It should also be noted that the SBA is for active businesses. We do not, fund people who are just investing. We want people who are actually running the business, right? So, there are times when the SBA would ask the bank to use their wherewithal, and if there's a director who has no equity whatsoever, to also guarantee. So, as you position the loan scenario with myself or another bank, you want to be able to draw the lines together that your and the signer's business acumen translates into the ability to demonstrate and run the business. That's not to say you won't have managers, you won't have, a hierarchical, a corporate structure where there could be an entire management team in place, but we do want directors and the equity partners over 20% to sign. Getting back to the mezzanine and source funding, that along those lines. That said, source funding, just be aware if someone's going to take more than 20%, what that would mean from a guaranteeing standpoint. And mezzanine debt is something I've been seeing a lot more in the past 3 years or so. Mezzanine is essentially someone coming in who is not taking equity, who is structuring the deal, in probably a shorter time frame, possibly a higher rate than the SBA will. But it's a great way to reduce the exposure for the bank. I've used it in scenarios where transactions are over that $5 million mark, and the SBA max is $5 million, but we get the mezzanine debt to come in at $500,000, $1 million to lower that to SBA standards, or if the goodwill is just significantly higher than a bank would lend to, we can have mezzanine come in and do that as well. So that is also on the table. And then last bullet point, just before we move on to questions, is again to discuss working capital and inventory. We typically want the working capital documented. The inventory is very easy to document, but the last thing I'll just say is we will fund working capital. We do want to see some kind of cash cycle need for the business. If it's a 30-day receivable, that's when we're more likely to give more working capital. If you're hiring an individual engineer or you're paying salaries or you want to beef up marketing, that is also on the table. Significant working capital needs, we could ask for a business plan. But that's usually atypical with a business purchase. You do have historical cash flow, so if we can document the working capital, we should be in good shape. And that said, I believe Kevin had mentioned we can open this up to questions, and I know
for any buyers that
we
are
actually
interested
do have a few questions.
an SBA acquisition with us.
And before I turn over to Kevin, the last thing I'll just say about myself
want
is,
you guys to speak with
this is a high-level overview.
Speaking with
We
Jordan
should be
before we potentially
moving
progress your interest forward and
onto a conversation where you actually
we
engage
just
the
want to make
banker
sure
prior
that
to an LOI.
not just from a business standpoint, but
I
also
know
from
people
a
will
personal
ask when
or the
should we
borrower
actually
standpoint, that
discuss this.
the
The answer
acquisition
is,
is a possibility
as quickly as
before
possible.
all parties
So connect with me,
further
shoot me an
time
email.
into
You can
something
also
that may
find
not
me pretty
materialize.
readily on LinkedIn as well.
Okay. Well, that's it.
I'm happy to have
with
those,
that said, for those of you
more-in-depth
joining us here
conversations.
today, you have the
And that
ability
said,
to ask
I'll
questions
turn it
at
over
the
to Kevin.
bottom.
I didn't know if you had specific questions
we
you
can
wanted to
get to
go
that
over. If anyone
in a little bit.
chimed in with
We did
one, I'm
receive some
happy to
questions from
field it at this
buyers
point.
before this webinar, and I thought it might be prudent to just go through those first, given that they are pretty good questions. So Jordan, I'll fire these questions over to you, and then if you could provide your insight, I think we could do more of a Q&A format. Sure. So the first question that we received was how to get pre-approval for SBA loans and be ready with pre-approval. The challenge for this buyer is to get approval before knowing much information about the next opportunity that's presented. And most vendors want to know details about the business before giving pre-approval. So how do you balance something like a chicken and an egg situation? there in regards to the information requirements, which was a question from another buyer, is so you said a resume is needed, and my understanding is that there's a personal balance statement as well as a business plan. What are the other documents that you would need to vet a borrower personally? And this is a question for me because it just come up in light of your this explanation is I have seen buyers come to the table with a pre-approval for X amount of dollars. Is that just what a bank may have determined that they would be eligible for, just looking at their personal situation, so their global cash flow and what size acquisition or what size loan they'd be able to support?
Yeah, so I have a
business?
very regimented way of doing this, especially
Going
with
back
you
to
guys,
some of
Kevin.
the questions,
And really,
here's
I think
one
it's
from
worked
another
out well.
buyer. Can a business get an
I
SBA
completely
loan to
understand
buy a
that
business
you're
or
looking
only
at
as an
several
individual?
different businesses.
And I think you
You
covered this in
don't
the
know
presentation a
what
little
the
bit.
certain
For
eccentricities
example,
are
I
of
am the
each
only owner
individual
of an LLC with
transaction.
down
So
payment funds in it.
what I
Do I
say
need to
is,
get those funds to a
involve
personal account
me
before I get
quickly.
approved for the loan, or what
I
is the
have
simplest
a
way you
laundry
could do
list
that?
of documentation I ask for up
Let's
front.
just go back
Once
very
I get
quickly
that,
to the
and, it's
20%.
like 5 or 6 documents.
That
I'm
point that
able
you
to say,
mentioned.
okay, here's
So here's another question for
kind of
you.
how well capitalized we want
I've
you.
heard that there
Here's
are
what the working
options to have a
capital
silent partner
need
that
will
has less
be.
than 20% of
This is the
equity in the
liquidity
business
that we would
and
like
would
to see,
provide part
and I can
or
kind of
all of the
reverse
down
engineer
payment in
that
order to
into a deal
secure an
size
SBA
or
loan.
a loan size.
Would it be possible to outline
And
how
then,
that process would
part
work,
of
or if
one
it's
of the
actually a
documents I do
feasible
ask
option
for
when
is a
buying an online
resume,
business?
and there is a discussion about your
More
transferable
questions for
skills
you.
in
I
the
know we
business
have
you want
about
to
10
buy.
minutes left, so we can just
And
wrap
I
up
think we've
quickly.
had success
Do
in screening
SBA
buyers
loans require
and
reserve
giving them a
funds
good
before someone
takeaway
can be
of what
approved?
they're going
If
to
so,
need,
how much needs to be in reserve?
and what kind of deal size they should be targeting. But yeah, I completely understand. There is this isn't a mortgage.
We do have a
where
handful
you go out
of
and you want to
buyers
buy a
that are
house,
U.S.
and before
citizens
you put a
or
bid
primarily
down,
based in
you
the
need
U.S., but for whatever
pre-approval.
reason,
That doesn't
may
really
be
exist in
based
the M&A
overseas.
world. But that conversation.
What are the requirements that they should consider there?
To have, I
You
think,
can
is the
run
most
them
important.
agnostic of location.
The way I put it with borrowers is, I can issue a
enlightening to
term
hear
sheet, but that term sheet
SBA
comes with a
is
clock,
just
an
as
expiration
agnostic
date,
to
and
some
also the need
extent.
for a deposit. So it's much better off to have that preliminary conversation, certainly prior to an LOI. Issue the LOI to the seller, and then once
actually,
it's
reading through this
accepted,
now,
we'll
I
turn
think you
around
may
and give you a
enjoy
term
answering
sheet
this.
because we've already had those discussions.
So during the
and
presentation,
immediately
you
enter
touched
credit.
on the lending rate being prime plus some spread. What are your thoughts on whether a buyer should go bank shopping to get the best rate? Is the effort worth the benefit? Is you want to be working with a bank that has done these online business goodwill acquisitions before, because at the end of the day, it's marginal differences just because of the federal standards that have been set. So the person that you are working with,
really,
your lender, should be
the
fairly
borrower
adept
does
in this
not have
industry. So that's quite
self-employment
an
history,
important
or this
characteristic
is
there
not
that I feel
synergistic.
that all buyers and
it's someone
borrowers
coming
should take
from
into
a
consideration.
high-level corporate world, high-level tech world, and they want to kind of use their skills to run their own business. There's significantly less to look at, but there will also be a smaller transaction
from
size.
your end, what are you seeing in the
So
SBA
that
space?
said, typically
looking
what I'll
forward a
want to
little bit, just in
see
light of where
is
we
the
are in the
SBA
economy
Form
and where the
413.
market is.
I'm
Are
going to
you
want to see a
seeing
resume,
activity increasing,
and
decreasing?
then any kind
The
of
type of
personal bio
borrowers that you're
or other
interacting
businesses
with,
you've run. That coupled with
increasing in
personal financials like
sophistication, or
tax returns,
what can you tell us there in terms of the trends that you're
will
seeing?
get me to a relatively quick decision.
Great.
And then if
Thank you,
the
Jordan,
buyer
for
does
your
have
insight, for your
existing
time.
businesses, that kind
For
of
those of you on
opens
the
up
call,
the door.
thank you
As
for
I
taking
was
time
saying
to join
earlier,
us
you
for
have
this session as
now
well.
global cash flow.
We hope that this
and then if you have the
information
global
that we
cash
shared with you was
flow,
very enlightening
we'll look
and
at business
can
tax
assist
return,
with
business
your
debt
ongoing acquisition
schedule,
efforts,
your
particularly through
AR,
SBA.
your capital needs for
As
your
you can see in
existing
the slide, this
business.
is our contact information.
But
Please feel
factor
free to
that
reach
in
out to either of us if you have any questions.
usually a higher debt service
But
payment.
Jordan, thank you again for your time, and I'm sure I'll speak with you very, very soon. Okay, great. Take care. Bye-bye.
Yeah, it's a good point, and I do those, but they're they're less official than an actual term sheet or LOI from the bank, because when you're funding goodwill transactions, the largest factor is the target company and the cash flow of that target company, and the predictability of that cash flow or future cash flow. So, the one scenario where you could actually really get a term sheet and know that you're in business is when the buyer has another business, and that existing business will service the debt of the target business. And I would say that is a very rare situation, maybe 1 in 10 times. You'll see a buyer who has that kind of cash flow and able to just float a new business with their existing one. Otherwise, typically it's going to be largely predicated on the target company. So those pre-approvals, are great and important to have that conversation. But more importantly, you really want to couple that their personal financials with the targeted business financials to get a much better answer. So we kind of alluded to this. You're right, but I think this is a good question because it gives you a little bit more clarity on the way that works. So just to be clear, you will give a personal guarantee with an SBA loan. That is something that's not going to go away. And to be quite frank, you give a personal guarantee on conventional business financing as well, unless you're significantly over middle market and almost SME kind of thing. So you do give a personal guarantee. That personal guarantee is attached as the owner of a business. So you come to Kevin, you want to buy a SaaS business. That business will be purchased by another business, by an LLC, and that LLC will have an equity breakdown and cap table, which is in this scenario is 100% solely one owner. That owner is giving a personal guarantee, and we will take any and all personal collateral to do that. And to tack on to the last slide I was dealing with, is any owner of that business, that LLC, if there was a 20% ownership or more, that person would also sign. So just to recap, the SBA makes loan for businesses, and the businesses have owners, and those owners give personal guarantees. I hope that clarifies everything. Sure. Yes, completely feasible. And you'll see that scenario in source funding. And it seems like the people who are funding these deals know that equity structure of under 20%. So that is all correct. The one thing I will tack on to that is, part of your qualification is, your business experience and acumen and your ability to run the business. So that must check out, not the private investors, the one who are actively running the business. And two, beyond the down payment, or in the SBA world, it's called equity injection. Beyond the actual equity injection, we need to see a degree of post-transaction liquidity. I personally, the transactions that have been most successful, there's certainly over 6 months of liquidity, and that's all business and personal. The most successful transactions seem to be 9 to 12 months of liquidity. That is rarely funded by a silent partner or investor. So, as you're kind of structuring a deal with an investor, working capital has to be a large consideration. We want to see that you are either funded by that investor with working capital, or you have it yourself. So just keep that in mind. Beyond equity injection, that'll be a large consideration if that structure will work. It's funny you should ask that. I think we got a pretty clear answer from the last question. But yeah, we do want to see reserves of all personal liquidity, all other business debt payments. So if you have a mortgage of $2,000 a month, a business loan of $2,000 a month, and the proposed debt payment is $4,000 a month, that's $8,000 of monthly obligations. Call it another maybe $2,000 as we calculate your just overall living expenses if you have a non-working spouse or if you have kids, car payments. So let's say you had a $10,000 monthly obligation between all businesses, proposed debt, and personal financials. We would want to see, like I said, I mean, we have historically gone under 6 months. So that is possible and on the table, especially with the cash flow you're buying. However, that is a good benchmark to use. I personally like to see 6 to 9 months, and I think 9 to 12 months really, help a deal get approved. And anything over 12 months, I would consider as a significant credit enhancement that would offset, a shortfall in another area where we're having an issue for an approval. If you showed me 2 years of liquidity, that's a significant credit enhancement and goes very far. Right. So again, the assets have to be coming into a U.S. corporation. So when we buy goodwill, when we buy intangibles, everything has to be folded into the assets of a U.S. corporation. That said, if we have an international buyer who is a U.S. citizen and does spend time abroad, that's okay. When the larger issue, and I would say e-commerce and tech, that's less of a consideration than if we were to do manufacturing or a franchise package resale. You see it often where people will live in New Jersey and they want to run a manufacturing firm in Florida. That's a little bit more difficult because there is some kind of on-site oversight that's really needed. And with a strong enough business plan and someone who's demonstrated business acumen, those are things we can work with and get around. Again, we really want to make sure that we're not, there is management oversight. However, in the online business world, there is much less of a physical presence. So, the deal that we actually just closed, you and I, the inventory was halfway across the country. That's less of an issue. I mean, we don't need inventory oversight, especially if that's just sitting in a warehouse that we don't even own. But yes, I hope that helps to put a capstone on. Yeah, for online businesses, less important, but certainly a consideration. And if there is physical oversight that's necessary, we need to cross that bridge as we come to it. Yeah, and to be really granular, I mean, the loan we closed, the buyer was in South Carolina. I think the seller was in Minnesota, and the inventory was in California. And that was fine. I mean, he demonstrated he doesn't need any physical oversight of the inventory, so that's fine. So, SBA lending is relatively a parity product. A 7A loan has minimum, maximum, or maximum rates set by the SBA. And when you're dealing with large goodwill transactions, I mean, 9 out of 10 banks will do prime plus 275. I price my loans at prime plus 2.5 to really avoid shopping, because you might see a bank that isn't familiar with doing tech stuff. They're not familiar with large goodwill, and maybe they'll come in at a quarter less. But having someone who actually does these transactions, I think, is the most important thing. If you see some relatively large variances, that's when you want to be incredibly wary. And I will tell you, if you see a larger variance than what I just said, it's usually going to be coming from a very large corporate bank, one of the 4 large corporates in America. They typically do not do goodwill without historical cash flow. So you would be behooved to shop if you have a business that can float the debt and service the debt, 2 times over without the target business. If you need the target business to support that debt, I don't really see in the marketplace someone coming in lower. I see many people coming in higher, and good for you if you can do it. So, certain banks like the Wells Fargos, the Chases, I mean, they'll do it, but again, you need historical of your existing business, not the target business cash flow to service the debt. And then the last thing I'll say is, you should know that, the cost of credit, being worth the benefit. This isn't a loan you're paying for 30 years. So, I mean, the cost of interest being 0.25% lower, and you really don't see much more than 0.25% variance. But if you see someone coming in with like a fixed rate that's 1% below market and they're not used to these deals, that decline or not getting approved could potentially cancel the transaction entirely. Many banks will take 2 to 4 weeks, depending on the complexity, to issue a commitment letter or an approval. Meanwhile, if the seller gets a decline a month into the transaction, it's very common where they want to back out, and that may kill the deal entirely. So just be wary. But yeah, the SBA is kind of a parity thing, and makes everyone's job a little bit easier. Yeah. Yeah. I mean, I'll give you a very plain example, plain English example. I'm doing just a synergistic acquisition of a moving company. The guys do almost $1 million in net revenue already, and they can service the debt. They were thinking about going to TD Bank, and TD is not going to fund, an e-commerce or SaaS business to begin with. But if you ask their SBA lender that if they do goodwill transactions or business acquisitions, the answer is yes. These guys are going to get probably a rate that's, prime plus, 2, which is below market, and, good for them, but they have a very successful business on their hands already. Yeah, and if TD were to decline that loan, I would imagine the deal would blow up entirely. So you just have to be careful and find someone who's used to these transactions. Yeah, so I think like I said, over the last 24 to 36 months, the need for SBA lending, I think, has gone up just as the business cycle is kind of, has really plateaued in a good way. So I am seeing, the velocity and volume of transactions increase. Also with the SBA now deleting the requirement for a 25% injection for goodwill, now we're down to 10%. So I am seeing a lot more transactions that fit the 7A bucket. And then I'll also say, the Fed has raised interest rates a full percent, or possibly even more, maybe 1.5% over the last 18 to 24 months as well. I do see that being a proactive move as our economy starts to plateau and maybe even shrink and possibly even have a recession. I think that raise in interest rates has been proactive. So now if we were to hit a recession, we can lower them. So that said, I think, who knows where the economy's going, but I mean, I have seen a level of stability, and I do see that the Fed has kind of accounted for the ability to be proactive in case the economy does soften. And then the Fed's most recent comments were that they have the ability and will be looking to lower interest rates to kind of kickstart something if from either a political or economical. If any of that gridlock happens, I think we have the tools to keep the economy plugging along. Hopefully that was helpful. Hopefully 6 months from now we're not re-listening to this singing a different tune, but that would be my off the cuff remarks about that. Perfect. Yeah. Thanks again, everyone. And thanks, Kevin, for setting this up. I really appreciate it. Thanks.